The autumn of 2006 descended upon Wall Street with a palpable chill, one that had little to do with the changing seasons. In the glass and steel canyons of Lower Manhattan and the manicured enclaves of Greenwich, Connecticut, a storm of unprecedented velocity was gathering. It was a tempest born not of weather, but of risk. Concentrated, leveraged, and catastrophically misjudged. Within the span of a single brutal week in September, the financial world watched in suspended disbelief as Amaranth Advisors, a hedge fund titan that had once seemed invincible, simply evaporated. It was a collapse so sudden, so total, that it sent tremors through the entire global financial system, leaving a trail of bewildered investors and panicked traders in its wake. The numbers alone were staggering, almost incomprehensible in their scale and speed. More than $6 billion. To be precise, $6.4 billion of investor capital, gone. It vanished not over months of poor performance or a slow, agonizing decline, but in a matter of days. This wasn't a gradual erosion of value, it was a financial detonation. The headlines screamed from the pages of the Wall Street Journal and the Financial Times, each one trying to capture the sheer magnitude of the disaster. Amaranth, a name once synonymous with sophisticated strategy and market prowess, instantly became a byword for hubris and ruin. The firm had managed over $9 billion in assets, a testament to the trust placed in it by pension funds, university endowments, and wealthy families. Now nearly two-thirds of that capital had been wiped out, leaving a gaping crater in the hedge fund landscape and forcing a painful reckoning for all who had believed in its myth. The epicenter of this financial earthquake was a series of massive, highly leveraged bets on the direction of natural gas prices. It was a complex, esoteric corner of the market far from the familiar world of stocks and bonds, yet it proved to be the undoing of a giant. As the markets turned violently and unexpectedly against Amaranth's positions, the losses began to cascade. Each tick of the market seemed to amplify the damage, compounding the firm's predicament until it became an unstoppable death spiral. The very strategies that had generated spectacular returns for Amaranth were now the instruments of its destruction, a harsh lesson in the dual nature of leverage. For a brief, terrifying moment, it seemed as if the entire industry was holding its breath, wondering if the contagion would spread. The story of Amaranth's fall is more than just a cautionary tale about market volatility or the dangers of a single oversized bet. It is a chronicle of how quickly fortunes can be reversed, how reputations built over years can be shattered in an instant, and how the intricate systems designed to manage risk can themselves become the source of systemic failure. The collapse was a public spectacle, played out in real time on trading screens and news tickers across the globe. It forced a generation of financiers to confront uncomfortable questions about risk management, corporate governance, and the cult of the star trader. The firm that was once the envy of its peers had become a ghost, a haunting reminder of the fine line between genius and catastrophe. Its name would forever be etched in the annals of financial history, a symbol of one of the most shocking hedge fund implosions of all time. At the heart of this sprawling financial drama stood one man, Nicholas Mounis. Before the fall, his was a name spoken with respect in the exclusive corridors of the hedge fund world. He was the founder, the chairman, and the guiding force behind Amaranth Advisors. Mounis was not a flamboyant Wall Street caricature. He projected an image of quiet competence and intellectual rigor. He had built his firm from the ground up, launching it in 2000 with a vision of creating a multi-strategy powerhouse, one capable of navigating diverse markets and delivering consistent, superior returns for its sophisticated clientele. For years, that vision was a stunning success. He attracted top-tier talent from across the industry, and cultivated an environment that rewarded bold thinking and aggressive, calculated risk-taking. Under his leadership, Amaranth became a magnet for institutional capital. Mounis was the architect of the Amaranth empire. He oversaw its rapid expansion from a promising startup into a multi-billion-dollar behemoth headquartered in the hedge fund capital of Greenwich. His reputation was built on a foundation of shrewd management and an ability to identify and empower talented traders. Investors trusted him not just with their money, but with the stewardship of their financial futures. They saw in him a steady hand, a leader who understood the complex machinery of modern finance and could harness it for their benefit. He was the quintessential hedge fund manager of his era, smart, driven, and seemingly in complete control of the vast and intricate trading operation he commanded. The firm's meteoric growth was a direct reflection of the industry's confidence in his abilities and his strategy. Yet, it was this very structure, one that relied on empowering star traders, that contained the seeds of its own destruction. While Amaranth was a multi-strategy fund in name, it had become increasingly dependent on the spectacular profits generated by a single division: energy trading. Specifically, it had concentrated an enormous amount of its capital and risk into the hands of one trader, Brian Hunter. This concentration of risk in one man's bets was a fateful decision, one that would ultimately fall on the shoulders of Maonis as the firm's leader. When the natural gas markets turned, the firm's lack of diversification was laid bare. The centralized control that Maonis embodied meant that he was not just the beneficiary of Amaranth's triumphs, but also the ultimate figure of accountability for its failures. As the firm imploded, the spotlight that had once illuminated his success now cast a harsh and unforgiving glare. Maonis was no longer the celebrated founder of a thriving enterprise. He was the captain of a ship that had sunk in spectacular fashion. The collapse transformed him overnight from a respected industry leader into a pariah. He was faced with a barrage of lawsuits from furious investors, intense scrutiny from regulators, and a trial by media that painted him as the architect of one of finance's greatest disasters. His name became inextricably linked with the Amaranth debacle, a permanent stain on a once pristine career. The man who had presided over a $9 billion fund found himself at the epicenter of a financial and reputational ruin from which few could ever imagine recovering. In the immediate aftermath of the collapse, the fallout was swift and merciless. Amaranth Advisors was not simply wounded, it was annihilated. The firm was forced into a fire sale of its remaining assets and a rapid, ignominious liquidation. The sleek Greenwich offices that once buzzed with the energy of billions of dollars fell silent. The logo was taken down, the phones stopped ringing, and what was once a titan ceased to exist. For Nicholas Maonis, this was more than the end of his company. It was the beginning of a profound and public exile. The world that had once celebrated him now ostracized him. He became a ghost on Wall Street, a name whispered as a cautionary tale in boardrooms and trading pits. The industry that prides itself on resilience and reinvention had seemingly closed its doors on him for good. The expectation among investors, regulators, and former colleagues was clear: Maonis would disappear. Most assumed he would take what remained of his personal fortune and retire quietly, living out his days far from the glare of the financial markets that had brought him both immense success and catastrophic failure. This is the typical path for founders whose firms implode so spectacularly. They retreat from public life seeking anonymity to escape the long shadow of their downfall. The weight of the lawsuits, the regulatory investigations, and the sheer humiliation of overseeing such a colossal loss of investor capital is often too much to bear. The industry has a long memory for failure, and a $6.4 billion failure is one that is not easily forgotten or forgiven. The narrative of Nicholas Maonis seemed to have reached its final tragic chapter. His name faded from the headlines, replaced by the burgeoning stories of the subprime mortgage crisis that would soon grip the global economy. For all intents and purposes, Maonis vanished from the professional world. He gave no major interviews, made no public statements defending his actions, and offered no roadmap for a potential return. This silence was interpreted by many as an admission of defeat, the quiet retreat of a man broken by events. He was no longer a player in the great game of finance, he was a relic of a past mistake, a symbol of an era of unchecked risk that had come to a calamitous end. The industry moved on, as it always does, to new booms, new busts, and new titans. The story of Amaranth and its founder seemed destined to be a footnote in financial history books. But behind this wall of silence, something else was happening. Something that almost no one in the financial world anticipated. While the industry was writing his professional obituary, Maonis was not retiring. He was reflecting. He was analyzing every misstep, every flawed assumption, and every broken process that led to the downfall of Amaranth. He was dissecting his own failure with the same intellectual rigor he had once applied to the markets. This period of quiet exile was not one of inactivity, but of intense introspection. He was not planning an escape, but a return. The man who had seemingly lost everything was quietly laying the groundwork for one of the most improbable and audacious comebacks in the history of modern finance, far from the prying eyes of the world that had cast him out. Just 2 years after the collapse that should have ended his career, A new entity quietly emerged in Greenwich, Connecticut. In 2008, as the world was reeling from a financial crisis far larger than Amaranth's implosion, Nicholas Maunis stepped back into the arena. He launched a new hedge fund, Veritio Fund Management. There was no fanfare, no splashy press release, no triumphant announcement. The launch was deliberately understated, almost secretive. It was the polar opposite of the high-flying, headline-grabbing culture that had characterized Amaranth's peak. This was not a continuation of his old firm. It was a direct response to its failure. The name itself, derived from the Latin word veritas meaning truth, signaled a new philosophy rooted in transparency and a clear-eyed view of reality. The core premise of Veritio was built directly upon the single most painful lesson learned from Amaranth's demise: never again allow one person or one strategy to hold the fate of the entire firm in their hands. Where Amaranth had become a concentrated bet on a star trader, Veritio was designed from its very DNA to be a fortress of diversification. The new model was a multi-manager platform, where capital was allocated across numerous independent portfolio teams, each operating with its own strategy and, most critically, its own strict and non-negotiable risk limits. Maunis was not just starting a new fund, he was building a new system, one engineered specifically to prevent the kind of catastrophic failure he had already experienced. This new venture was a monumental gamble of a different sort. Maunis was not just betting on markets, he was betting on redemption. He had to convince a small circle of investors to trust him again, to believe that he had learned from his cataclysmic failure and had built a stronger, more resilient model. He launched Veritio with a modest $185 million in assets, a mere fraction of Amaranth's former size, sourced from a handful of loyal backers who believed in his vision for a second act. It was a humble beginning for a man who had once helmed a $9 billion giant. The early days were a quiet, painstaking process of rebuilding trust, not with the entire industry but one investor, one trader, and one successful day at a time. The goal was no longer explosive growth but steady, risk-controlled performance. This is where the untold part of the story truly begins. The spectacular failure of Amaranth is a well-documented piece of financial history, but the quiet, methodical rise of Veritio is a narrative that unfolded largely beneath the surface, away from the media's gaze. It is the story of a man who did not run from his past but instead used its wreckage as the blueprint for his future. He transformed his greatest professional failure into a guiding doctrine for success, turning the very thing that destroyed him into the cornerstone of his new creation. The journey from the public disgrace of a $6.4 billion collapse to the quiet stewardship of a fund that would eventually manage nearly $12 billion is more than just a comeback. It is a powerful testament to resilience, reinvention, and the profound lessons that can only be forged in the crucible of failure. The year 2000 dawned with a sense of boundless optimism, a new millennium that promised technological revolution and endless market opportunities. It was in this heady atmosphere that I, Nicholas Maunis, a seasoned finance professional with a background in convertible arbitrage, decided to launch my own venture. I founded Amaranth Advisors in Greenwich, Connecticut, a town that had become the de facto capital of the hedge fund universe. The firm was born not out of a single revolutionary trading idea, but from a broader, more ambitious vision. I envisioned a multi-strategy powerhouse, a diversified platform that could deploy capital across various asset classes and strategies, from convertible bonds and merger arbitrage to credit and eventually, energy derivatives. The goal was to build a sophisticated institution that could thrive in any market environment. Amaranth's name, drawn from a mythical flower that never fades, was meant to symbolize longevity and enduring value, a promise of permanence in the notoriously fickle world of high finance. From the outset, I cultivated an image of intellectual rigor and institutional discipline. I sought to create a firm that was more than just a collection of traders. It was to be a cohesive entity built on a foundation of deep market knowledge and meticulous execution. This approach resonated powerfully with the institutional investors, pension funds, endowments, and foundations, who were increasingly looking to hedge funds for superior, non-correlated returns. They were drawn to Amaranth's promise of a stable, professionally managed platform that could navigate the complexities of modern markets with a steady hand. The early days were marked by a disciplined and methodical expansion. I began by building upon my own expertise in convertible arbitrage, a relatively low-risk strategy that involves trading convertible bonds and their underlying stocks. This provided a stable base of returns and helped establish the firm's credibility. From there, I carefully added other strategies to the mix, recruiting experienced portfolio managers and teams who could operate with a degree of autonomy but within the firm's overarching risk framework. The model was designed to be robust, with different strategies acting as counterweights to one another, smoothing out returns and reducing overall portfolio volatility. It was a classic multi-strategy approach, and for a time, it worked exactly as intended, attracting a steady inflow of capital. Under my leadership, Amaranth quickly grew from a promising startup into a respected name in the industry. Its assets under management swelled, crossing the billion-dollar threshold and continuing to climb. The firm's success was built on its ability to deliver on its promise of consistent, attractive returns, which in turn fueled a virtuous cycle of growth. More capital allowed me to attract even better talent, expand into new strategies, and take on more ambitious positions. The flower was in full bloom, and its vibrant colors were catching the eye of the entire financial world. Amaranth was no longer just another hedge fund, it was rapidly becoming a titan, a testament to my vision and the powerful allure of the multi-strategy model in the early 2000s. As Amaranth Advisors moved through the early 2000s, its growth trajectory was nothing short of spectacular. The firm's multi-strategy model proved to be incredibly effective in the post-dot-com bubble market environment. While some funds struggled with the shifting landscape, Amaranth's diversified approach allowed it to find pockets of opportunity across the financial spectrum. Its teams traded everything from distressed debt complex credit derivatives and arbitrage opportunities in global equity markets. This diversification was the firm's calling card, assuring investors that their capital was not exposed to the whims of any single market or asset class. The strategy was successful, and the assets under management continued their relentless upward march, solidifying Amaranth's position in the industry's top tier. I presided over this expansion with a reputation for being a sharp, detail-oriented manager. I was known for my deep understanding of the intricate mechanics of each strategy operating under my firm's umbrella. I fostered a culture that was both collaborative and intensely competitive, where portfolio managers were given the resources and freedom to pursue their ideas, but were also held to high standards of performance. The Greenwich headquarters became a hive of activity, attracting some of the brightest minds from Wall Street's most prestigious investment banks and rival hedge funds. The allure was simple. Amaranth was a winning team, a place where talented traders could build their careers and generate significant personal wealth while contributing to the firm's impressive track record. However, even within a diversified portfolio, some strategies inevitably perform better than others. Over time, one area within Amaranth began to shine with a particular brilliance: energy trading. As global demand for energy surged, driven by the rapid industrialization of China and other emerging economies, the markets for commodities like natural gas and crude oil became increasingly volatile and ripe with opportunity. Amaranth's energy desk, initially just one of many strategies, started posting extraordinary returns. The profits generated from this single division were so substantial that they began to overshadow the contributions from the firm's other, more traditional lines of business. This success was intoxicating, creating a powerful gravitational pull within the firm. This growing reliance on the energy desk marked a subtle but profound shift in the firm's character. While Amaranth was still a multi-strategy fund in structure, its soul was increasingly tied to the fortunes of the energy market. The consistent, outsized gains from energy trades made the steady, single-digit returns from convertible arbitrage or merger arbitrage seem almost pedestrian by comparison. Capital, by its very nature, flows to where it is treated best. And within Amaranth, the best returns were undeniably coming from the energy desk. This created a powerful internal momentum, gradually tilting the firm's balance away from its diversified roots and toward a more concentrated, singular focus, a path that was both incredibly profitable and fraught with hidden danger. The architect of Amaranth's spectacular success in the energy markets was a young, aggressive trader named Brian Hunter. A Canadian native from Alberta, Hunter had cut his teeth in the rough-and-tumble world of energy trading, first at a Canadian utility and later at Deutsche Bank in New York. He joined Amaranth in 2004, bringing with him a reputation for having an almost preternatural feel for the natural gas market. He was known for his supreme confidence, his relentless work ethic, and his willingness to make enormous high-conviction bets. In an industry filled with big personalities and even bigger appetites for risk, Brian Hunter stood out. He was exactly the kind of star trader that hedge funds dream of finding. Upon his arrival at Amaranth, Hunter was given the mandate to build out the firm's energy trading capabilities. He quickly assembled a team and began deploying capital into the complex and often opaque world of natural gas futures and derivatives. His primary strategy involved making massive bets on the future direction of natural gas prices, often using calendar spreads, trades that profit from the price difference between contracts for delivery in different months. These were highly leveraged positions, meaning even small, favorable movements in the market could generate colossal profits. And for a while, Hunter seemed to have the Midas touch. His trades were consistently, almost miraculously correct, producing a torrent of profits for the firm. Hunter's performance was staggering. In 2005 alone, his energy trading desk was reported to have made over $1 billion for Amaranth, a figure that represented a significant portion of the firm's total earnings. He became a legend within the firm, and a rising star in the commodity trading world, earning a bonus rumored to be in the tens of millions of dollars. He was the golden goose, and I, along with the firm's leadership, rewarded him accordingly. We allocated more and more of the firm's capital to his desk, trusting his judgment and his seemingly infallible ability to read the market. The energy desk was no longer just another part of the multi-strategy platform, it had become the engine of Amaranth's growth. The cult of the star trader began to take hold. Hunter's success created a powerful narrative within Amaranth, that he possessed a unique insight, a special skill that set him apart from ordinary mortals. When a single individual is responsible for such a disproportionate share of a firm's profits, the normal rules of risk management can begin to bend. Questions that might be asked of other traders were perhaps muted when it came to Hunter. His string of successes seemed to provide its own justification. The firm became increasingly comfortable with the enormous risks he was taking because, for a long time, those risks paid off handsomely. Brian Hunter was no longer just an employee. He was the firm's most valuable asset. The natural gas market is notoriously one of the most volatile commodity markets in the world. Prices can swing wildly based on weather forecasts, storage levels, pipeline disruptions, and hurricane seasons. It is a market that can make fortunes for those who guess its direction correctly, and bankrupt those who get it wrong. For Brian Hunter, this volatility was not a risk to be feared, but an opportunity to be exploited. His confidence, bolstered by his incredible track record in 2005, grew to epic proportions. He believed he had developed a superior model for predicting the seasonal fluctuations in natural gas prices, and he was willing to bet the house on it. The firm, mesmerized by the profits, was more than willing to let him. By 2006, Amaranth's risk profile had transformed dramatically. What was founded as a diversified multi-strategy fund had, in practice, become a highly concentrated, directional bet on the natural gas market. An ever larger portion of the firm's capital was funneled into Hunter's trades. The risk management systems that were designed to prevent any single strategy from dominating the portfolio were either overridden or recalibrated to accommodate the sheer scale of the energy desk's positions. The logic was seductive. Why allocate capital to strategies earning 8% a year when Hunter's desk was generating triple-digit returns? The siren song of easy profits was too powerful to resist. The scale of the positions became honestly breathtaking. By the summer of 2006, it was estimated that Amaranth, through Brian Hunter's trading, controlled a colossal share of the entire natural gas futures market on the New York Mercantile Exchange. The firm's positions were so large that they reportedly dwarfed those of major energy companies and utilities whose entire business revolved around the commodity. Amaranth was no longer just a participant in the market, it was the market. This level of concentration was a radical departure from the firm's founding principles. The fate of a $9 billion hedge fund with thousands of investors was now inextricably tied to the convictions of a single 32-year-old trader and the unpredictable weather patterns of the Gulf of Mexico. Hunter's core position was a massive bet that the price of winter natural gas contracts would rise significantly relative to the price of autumn contracts. This trade was predicated on the assumption that a disruptive event, such as a severe hurricane season similar to the one in 2005 that sent prices soaring, would create a supply crunch ahead of the winter heating season. It was a bold all-or-nothing bet. If he was right, the profits would be astronomical, potentially cementing Amaranth's place in the hedge fund pantheon, but if he was wrong, If the weather remained mild and storage levels high, the leveraged nature of the trades meant the losses would be equally catastrophic. The stage was set for a dramatic showdown between one trader's hubris and the unpredictable forces of the market. By mid-2006, Amaranth Advisors stood at the apex of its power and influence. With over $9.2 billion in assets under management, it was one of the largest and most successful hedge funds on the planet. Nicholas Maunis was lauded as a brilliant manager who had built a formidable financial institution. The firm was a destination for institutional capital, a trusted steward for the wealth of pensions and endowments. On the surface, everything seemed perfect. The firm's public image was one of sophisticated, diversified risk-taking, a model of the modern multi-strategy hedge fund. It was the embodiment of the amaranth flower from which it took its name, vibrant, thriving, and seemingly immortal in the competitive ecosystem of Wall Street. Beneath this veneer of success, however, the foundations were dangerously unstable. The firm's diversification had become an illusion. By some estimates, as much as half of the firm's entire capital was now effectively backing Brian Hunter's natural gas positions. The risk was not just concentrated in a single strategy, but in a single market, and ultimately, in the judgment of a single man. This extreme concentration violated the most fundamental tenets of prudent portfolio management. It was a classic case of hubris, a belief that past success guaranteed future returns and that the normal rules of risk did not apply to them. The firm had become addicted to the high-octane profits from the energy desk, and like any addiction, it blinded them to the immense danger they were courting. The warning signs were there for those who chose to see them. Other market participants and regulators were growing increasingly concerned about the size of Amaranth's positions. The firm's trades were so large they were distorting the market, leading to accusations that Amaranth was attempting to manipulate natural gas prices. Yet, inside the walls of the Greenwich headquarters, confidence remained unshaken. Hunter continued to double down on his bets, convinced that the market would eventually move in his favor. The firm's leadership, including Maunis, placed their faith in their star trader, allowing him to build a position of such magnitude that it left no room for error. There was no viable exit strategy if the market turned against them. As the summer of 2006 progressed, the conditions for Hunter's thesis failed to materialize. The hurricane season was unexpectedly mild. Natural gas production continued unabated, and storage facilities filled to the brim. The market fundamentals began to shift decisively against Amaranth's massive positions. The price of winter gas began to fall relative to autumn gas, the exact opposite of what Hunter had bet on. The firm was standing on the precipice of disaster, holding a lit stick of dynamite. The once unfading flower was beginning to wilt, and the financial world was about to witness just how quickly a $9 billion giant could be brought to its knees by the unforgiving logic of the market. The rise was over. The fall was about to begin. September 2006 arrived, but inside Amaranth Advisors panic was brewing. The firm's massive bet on a cold winter and hurricanes was unraveling. Natural gas was abundant, storage was full, and prices were falling. Brian Hunter's conviction became a fatal flaw as he doubled down, ignoring mounting losses. Risk controls failed, the market sensed weakness and pounced, accelerating Amaranth's collapse. Margin calls mounted, and the firm was trapped in a vicious cycle of forced selling and plummeting prices. For Amaranth, this September would be remembered as the beginning of the end. Amaranth's bet ignored the basics. Supply was high, demand was mild, and the market was rational. Hunter's complex calendar spreads, betting on a winter price surge, imploded as storage overflowed and spreads collapsed. Amaranth's massive positions made it a target. Rivals shorted the same contracts, deepening the losses. The firm was trapped, unable to exit without triggering further collapse. Hunter's reputation as a genius evaporated. The market's fundamentals had won. The collapse was now inevitable. Leverage had built Amaranth's empire, and now it was destroying it. As losses mounted, margin calls forced the firm to liquidate other assets, turning a single bad bet into a firm-wide disaster. Each day brought staggering losses, hundreds of millions, then billions. Risk controls failed. Panic set in as the firm's value evaporated. Nicholas Maunis scrambled to save what he could, but the math was merciless. Leverage, once a tool for growth, became the engine of Amaranth's ruin. Facing collapse, Amaranth scrambled to sell its toxic energy portfolio to anyone willing to take the risk. Banks and hedge funds balked at the price and risk, negotiations stalled. Citadel and Merrill Lynch considered a deal but only took small pieces. No savior emerged, the fire sale failed. Amaranth was forced to dump its positions into a hostile market, guaranteeing catastrophic losses. The search for a lifeline ended in defeat. Amaranth's liquidation was a surrender. $6.4 billion lost in days, wiping out two-thirds of its capital. Pension funds, endowments, and charities suffered massive losses. Trust was shattered. The collapse triggered regulatory investigations and shook the hedge fund industry. Careers were destroyed, Brian Hunter vanished from the scene, and Nicholas Mounis's legacy was ruined. Amaranth became a cautionary tale of unchecked risk and hubris. The flower that once symbolized resilience was now a symbol of spectacular failure. In the weeks and months following the September collapse, the final act of the Amaranth saga played out with grim predictability. The firm was officially wound down, its remaining assets liquidated and distributed to what was left of its investor base. The sleek Greenwich offices were shuttered, and the hundreds of employees who had once worked there were scattered to the winds, their resumes now carrying the stain of having worked for one of finance's most notorious failures. The name Amaranth, once a symbol of enduring success, was now a toxic brand, a shorthand for hubris and catastrophic risk management failure. The industry that had once celebrated its rise now dissected its fall with a mixture of morbid fascination and, honestly, a bit of schadenfreude. The legal battles began almost immediately. Furious investors, led by the San Diego Pension Fund, filed a flurry of lawsuits against me, Brian Hunter, and the firm itself. They alleged fraud, gross negligence, and a breach of fiduciary duty. The core of their argument was that Amaranth had fundamentally misrepresented its strategy. Investors believed they were buying into a diversified multi-strategy fund, but in reality, they were unknowingly funding a massively leveraged directional bet on natural gas. These legal challenges would drag on for years, a costly and high-profile post-mortem of the firm's mistakes, further cementing the narrative of a firm that had betrayed the trust of its clients in the pursuit of reckless profits. Regulators, too, circled the wreckage. The Commodity Futures Trading Commission brought a civil enforcement action against Amaranth and Brian Hunter, accusing them of attempting to manipulate the price of natural gas futures. While the most serious charges of manipulation were eventually settled or dismissed, the regulatory scrutiny was intense and prolonged. The case highlighted the regulatory gaps that allowed a hedge fund to operate with such massive leverage in critical commodity markets. The Amaranth collapse became a key exhibit for proponents of stricter financial regulation, influencing provisions in the Dodd-Frank Act that would be passed years later in the wake of the 2008 crisis. The firm's failure had consequences that rippled far beyond its own investors. For me, the public fall from grace was complete. I went from being the respected head of a multi-billion-dollar firm to an industry pariah facing lawsuits and regulatory investigations. I largely disappeared from public view, retreating from the financial world that had been my life's work. The Titan had fallen to earth, and the crater it left was a stark reminder of the brutal nature of the markets. Most observers assumed this was the end of my story, a definitive and ignominious conclusion to a once-storied career. There seemed to be no path back from a failure of this magnitude. The conventional wisdom was clear. For Nicholas Mounis and Amaranth, there would be no second act. The end of Amaranth Advisors was not a graceful decline. It was a brutal, systematic dismantling. Once the final catastrophic losses were realized, the firm ceased to be a going concern. It became a carcass for lawyers and liquidators to pick over, a complex estate to be unwound under the unforgiving glare of its creditors and investors. The primary task was to sell off any remaining assets, a process fraught with difficulty. The firm's non-energy portfolios, which included perfectly sound strategies in convertible bonds and merger arbitrage, were now tainted by association. They were sold off at fire sale prices to other funds, their value diminished by the stench of Amaranth's failure. It was a somber process of erasing a once great name from the Wall Street ledger, piece by painful piece. The human cost of this dissolution was immense and immediate. Hundreds of employees, from senior portfolio managers to junior analysts and back-office staff, found themselves out of a job overnight. They were the collateral damage of a crisis they did not create. Their professional lives were thrown into turmoil, their resumes now bearing the mark of a firm that had become a byword for disaster. The vibrant, competitive culture within the Greenwich headquarters evaporated, replaced by an atmosphere of shock and uncertainty. The teams that had been built, the strategies that had been honed, and the careers that had flourished under the Amaranth banner were all extinguished in the blink of an eye, a stark reminder of the fragility of success in the world of high finance. The physical symbols of the firm's existence were also methodically removed. The sleek, modern offices in Greenwich, once a bustling hub of financial power, were emptied out. Desks were cleared, computers were powered down, and the art was taken off the walls. The final symbolic act was the removal of the Amaranth Advisors sign from the building's exterior. This simple action was laden with meaning. It was the definitive statement that the firm was truly gone, its identity scrubbed from the landscape of hedge fund capital. What was once a destination for the industry's top talent became just another vacant office space, haunted by the ghost of billions of dollars lost and a reputation shattered beyond repair. For the financial industry, the swiftness of the dissolution was a sobering spectacle. It demonstrated that no firm, no matter how large or successful, was immune to a catastrophic failure of risk management. Amaranth's demise served as a crucial lesson in the importance of true diversification and the dangers of the cult of the star trader. The firm that was named for a mythical flower that never fades had, in the end, wilted and died in a matter of days. Its complete and total erasure from the industry was a powerful message to all who remained. Risk is real, failure is absolute, and the market has no memory for yesterday's heroes when they become today's cautionary tale. The name Amaranth was now history. The financial collapse of Amaranth quickly morphed into a protracted and honestly pretty ugly legal war. The battlefield was not the trading floor, but the courtroom, and the fight was waged on multiple fronts. The first wave of attacks came from the investors who had lost the most. Led by the San Diego County Employees Retirement Association, a powerful institutional player that had lost more than $100 million, a consortium of pension funds and other investors filed a massive lawsuit. They accused me, Brian Hunter, and other senior figures at the firm of gross negligence, breach of fiduciary duty, and most damningly, fraud. Their central claim was that Amaranth had fundamentally deceived them about its investment strategy and risk controls. The investor lawsuits painted a picture of a firm that had abandoned its founding principles. They argued that Amaranth had marketed itself as a safe, diversified multi-strategy fund, a suitable investment for the conservative capital of retirees and endowments. Yet, behind the scenes it had transformed into a speculative, highly leveraged bet on a single, volatile commodity market. The legal filings alleged that my team and I had not only allowed this to happen, but had actively concealed the true extent of the risk from our clients. The lawsuits sought to claw back hundreds of millions of dollars in lost capital, turning the firm's collapse into a bitter and personal fight over accountability and trust. At the same time, Amaranth found itself in the crosshairs of federal regulators. The Commodity Futures Trading Commission, or CFTC, and the Securities and Exchange Commission, the SEC, launched their own extensive investigations. The CFTC focused on whether Amaranth and Brian Hunter had attempted to manipulate the natural gas market, using the sheer size of their positions to illegally influence prices. This probe delved deep into the firm's trading records, emails, and internal communications, searching for evidence of intent to corner the market. The regulatory battle added another layer of complexity and peril for me and my former colleagues, carrying the threat of hefty fines, trading bans, and honestly, even further damage to our already ruined reputations. This multi-front legal war would drag on for years, long after the firm itself had ceased to exist. It became a grueling war of attrition, fought through depositions, motions, and settlement negotiations. For me, it meant my name remained in the headlines for all the wrong reasons. I was no longer just the founder of a failed firm. I was a defendant in a series of high-stakes legal battles that questioned my integrity and competence. The fallout from the collapse was not a single event, but a long, drawn-out process of public scrutiny and legal jeopardy. I was fighting not just for my remaining fortune, but for what was left of my professional legacy in the face of a legal onslaught. While the courts would take years to render their judgments, the Court of Industry Opinion delivered its verdict almost instantly. In the exclusive, tight-knit world of hedge funds, I became a pariah. My failure was not just a business loss, it was seen as a betrayal of the unwritten rules of the game, I had allowed a single trader to blow up a major firm, jeopardizing not only my own investors' capital, but also casting a negative light on the entire industry at a time when it was already facing increased scrutiny. The Amaranth collapse was a public relations disaster for hedge funds, reinforcing the stereotype of reckless gunslingers making wild, irresponsible bets. For this, I was ostracized by my peers. The social and professional exile was swift and total. The invitations to industry conferences, the friendly calls from other fund managers, and the respectful nods in the high-end restaurants of Greenwich all disappeared. I was now on the outside looking in, a ghost in the world I had once helped to build. In finance, reputation is currency, and mine had been devalued to zero. No one wanted to be associated with the man who had presided over a $6.4 billion loss. I was a walking, talking reminder of the worst kind of failure, and the industry, keen to protect its own image, effectively excommunicated me. This isolation was a profound form of punishment, a silent but clear verdict from the community I had once led. The story of Amaranth became a mandatory case study in what not to do. Business schools, risk management departments, and compliance teams across Wall Street dissected the failure with forensic detail. I was not portrayed as a tragic hero, but as a cautionary figure, a manager who fell victim to the siren song of outsized returns and lost control of his own firm. The lessons were clear: the dangers of style drift, the folly of overriding risk limits for a star performer, and the critical importance of a culture that empowers risk managers to say no. My name became synonymous with a catastrophic lapse in judgment, a legacy that seemed impossible to overcome. This industry verdict seemed to seal my fate. In a world that values winners above all else, there is little room for redemption after a failure of such public and epic proportions. The common wisdom was that I would never manage investor capital again. Who would trust me? Who would back me? I had committed the cardinal sin of losing a truly staggering amount of other people's money. The industry had rendered its judgment, and the sentence was a lifetime of exile from the profession. My story was considered over, a closed chapter in the annals of financial history, and no one expected me to even attempt to write another one. Faced with the wreckage of my firm, a barrage of lawsuits, and my complete ostracization from the industry, I did what most people in my position would do. I disappeared. I retreated from the public eye entirely, embracing a self-imposed exile. There were no television interviews, no tell-all articles in the financial press, and no public apologies or explanations. I simply vanished from the world that had defined my professional life. This silence was profound and honestly deafening. In an age of constant media cycles, my ability to withdraw so completely was a feat in itself, but it was also interpreted by the outside world as an admission of defeat and shame. This period of public invisibility lasted for nearly 2 years. For the financial world, it was a case of out of sight, out of mind. The industry moved on to the next big crisis, the subprime mortgage meltdown, which would soon dwarf Amaranth's collapse in scale and consequence. My story faded from the front pages, becoming a historical footnote. The assumption was that I was living quietly, managing my personal affairs, and waiting for the legal storms to pass. The idea that I might be planning a return to the very industry that had cast me out seemed not just improbable but completely unthinkable. The shadow of my $6.4 billion failure was simply too large to escape. However, this public silence masked a period of intense private activity. I was not idle. I was not licking my wounds in quiet retirement. Instead, I was engaged in a deep and rigorous post-mortem of my own failure. I was dissecting every decision, every flawed process, and every misjudgment that led to Amaranth's demise. This was not an exercise in self-pity, but a cold, hard analysis. I was determined to understand the DNA of my disaster, not to excuse it, but to learn from it. This period of quiet reflection was the crucible in which the philosophy for my next venture would be forged, far from the prying eyes of the world. The disappearance, therefore, was not an end, but a necessary intermission. It was a strategic retreat, a time to regroup, rethink, and rebuild a new framework from the ground up. I understood that I could not simply reappear and ask for a second chance. I needed to return with a new model, a new philosophy, and a convincing answer to the one question everyone would ask: why should this time be any different? The fallout from Amaranth had been devastating, but within that devastation, I was quietly gathering the seeds for an improbable and unforeseen second act. The man in the shadows was not hiding, he was preparing. In the tumultuous year of 2008, as the global financial system was convulsing from the Lehman Brothers bankruptcy, and the subprime mortgage crisis, an almost imperceptible event took place in Greenwich, Connecticut. Nicholas Maunis, the man who had vanished from the industry 2 years prior, quietly re-emerged. He founded a new hedge fund, Veritio Fund Management. There was no grand opening, no press tour, and no announcement in the Wall Street Journal. The launch was executed with the subtlety of a ghost, a stark contrast to the high-profile, aggressive culture that had defined Amaranth's existence. This was a deliberate choice, a signal that this new venture was fundamentally different in its purpose, its philosophy, and its ambition. It was a return, but one conducted in the shadows, far from the spotlight that had once burned him so badly. The timing of the launch was in itself a statement. To start a new hedge fund in the depths of the worst financial crisis since the Great Depression was an act of profound, almost defiant optimism. Capital was scarce, investor trust was at an all-time low, and the entire industry was in a state of retrenchment and fear. For Maunis to step back into this environment was a monumental risk. He was not only battling the ghosts of his own past, but also the headwinds of a historic market meltdown. Yet, it was perhaps the perfect time to introduce a firm built on the principles of caution and resilience. In a world suddenly terrified of risk, a manager who had learned its lessons in the most public and painful way possible might just have a compelling story to tell. The choice of Greenwich as the headquarters was also significant. Maunis did not run to a new city or try to hide in a different financial center. He returned to the very same town where Amaranth had risen and fallen, the epicenter of his previous triumph and disaster. This was not an act of hubris, but one of confronting his history head-on. By planting his new flag in the same soil, he was making an implicit statement that he was not running from his past. He was acknowledging it, owning it, and building his future in its full view. It was a quiet declaration that his story in this town was not finished, and that the final chapter had yet to be written. This was not just a new business, it was a reclamation project. The genesis of Veritio was therefore a study in contrasts. It was a bold move made with quiet humility, a new beginning forged directly from an old ending. Nicholas Maunis was no longer the celebrated titan of a multi-billion-dollar empire. He was the founder of a startup, returning to the arena not with a swagger, but with the sober perspective of someone who had stared into the abyss. The goal was not to rebuild Amaranth or recapture its former glory. The goal was to build something entirely new, something stronger, and something that could endure. Veritio was born not from a vision of boundless growth, but from the hard-won wisdom of a catastrophic failure, marking the beginning of one of finance's most improbable second acts. The entire philosophical and structural foundation of Veritio was built upon a single, powerful doctrine: never again. Never again would the firm be beholden to a single star trader. Never again would one strategy be allowed to dominate the portfolio. Never again would a single, oversized bet hold the power to sink the entire ship. This was the core lesson learned from the ashes of Amaranth, and Maunis etched it into the very DNA of his new firm. Where Amaranth had devolved into a concentrated gamble, Veritio was engineered from day one to be a fortress of diversification and decentralized risk. The new model was a direct and unequivocal rejection of the old one, a redemption doctrine designed to prevent history from repeating itself. The practical application of this doctrine was the creation of a true multi-manager, multi-strategy platform. Unlike Amaranth in its final days, Veritio would allocate its capital across a wide array of independent portfolio management teams. Each team would operate as a discrete business unit, pursuing its own specialized strategy, from quantitative equity trading to credit arbitrage to global macro. The crucial difference was that each team would be subject to strict predetermined risk limits. There would be no exceptions. No single portfolio manager, no matter how successful, would be allowed to accumulate the kind of exposure that Brian Hunter had. The system was designed to ensure that the failure of any one strategy would be a manageable loss, not an existential threat to the firm. This structure fundamentally changed the role of Maunis himself. At Amaranth, he had become the enabler of a star trader, the leader who ultimately sanctioned the concentration of risk. At Veritio, his role was transformed into that of a master risk allocator and overseer. His primary job was no longer to find the one big winning trade, but to build and manage a resilient ecosystem of many smaller, uncorrelated trades. He was the architect of the system, responsible for setting the risk budgets for each team, monitoring their performance, and ensuring that the overall portfolio remained balanced and protected from catastrophic drawdowns. He was moving from being the king of a single kingdom to the president of a federation of states. This new model was Maonis's answer to the question that hung over his return: why should this time be different? The answer was not a promise or a plea for trust. It was a system. It was a tangible, structural change that addressed the exact flaw that had led to his downfall. The redemption doctrine was not about personal rehabilitation. It was about building a better, safer machine for managing capital. By creating a firm where no single point of failure existed, he was building the ultimate defense against his own past mistakes. Veritio was not just a new name, it was a new philosophy of survival, built on the painful but powerful lessons of his past. Launching a new hedge fund is a monumental challenge, even for a manager with a pristine track record. For Nicholas Maonis, a man whose name was synonymous with one of the biggest hedge fund blow-ups in history, the task was Herculean. The first and most critical hurdle was raising capital. He couldn't simply send out a prospectus to the broad institutional market. The name Amaranth was still too toxic. Instead, he had to rely on a small, tight circle of individuals and family offices who had known him for years, people who were willing to look beyond the headlines and bet on the man and his new, chastened philosophy. This was a painstaking personal process of rebuilding trust, one conversation at a time. The initial capital for Veritio was not sourced from the giant pension funds and endowments that had backed Amaranth. It came from a handful of loyalists, former colleagues, business partners, and high-net-worth investors who had a deep, long-standing relationship with Maonis. These were the first believers. They were willing to take a leap of faith based on their personal assessment of his character and his detailed explanation of the new, risk-controlled model. They understood the failure of Amaranth intimately, but they also believed that Maonis had learned from it in a way that few others could. They were not just investing in a strategy, they were investing in a story of redemption, betting that the lessons from his failure would make him a better, wiser steward of capital. Veritio launched in 2008 with a modest $185 million in assets under management. This was a tiny sum compared to the $9 billion Amaranth had once commanded, a clear reflection of his diminished standing in the industry. But this small seed capital was incredibly significant. It was proof that redemption was possible, that a small group of sophisticated investors was willing to give him a second chance. This initial funding was the lifeblood that allowed the new firm to open its doors, hire its first teams, and begin building a track record. Every dollar of that $185 million represented a hard-won victory in his battle to reclaim his place in the financial world. Assembling this initial capital was perhaps the most difficult part of the entire comeback. It required Maonis to be humble, to confront his past failures directly, and to make a compelling case for why the future would be different. He could not sell a story of spectacular returns. He had to sell a story of discipline, structure, and survival. The fact that he succeeded in convincing anyone to back him is a testament to his perseverance and the power of his new vision. The first believers were not just providing money, they were providing the validation he needed to begin the long, slow process of rebuilding his name and his firm from the ground up. The name of the new firm, Veritio, was a carefully chosen signal of its core philosophy. Derived from the Latin word veritas, meaning truth, the name itself was a mission statement. It represented a commitment to seeing the world, the markets, and most importantly, risk, with clear-eyed, unvarnished honesty. This was a direct repudiation of the hubris and self-delusion that had allowed Amaranth to believe it could outsmart the fundamental laws of the market. The philosophy of Veritio was to be rooted in reality, in data, and in a humble acceptance of what the firm did and did not know. It was about stripping away the narrative and focusing on the verifiable truth of its positions and exposures at all times. This commitment to truth extended to a new emphasis on transparency both internally and with its investors. At Amaranth, the complexity and scale of the energy desk's positions had become opaque, even to some within the firm. At Veritio, the model was designed for clarity. The risk management systems were built to provide a real-time, comprehensive view of the entire firm's exposure, aggregated from all the individual portfolio teams. Maonis and his leadership team would have a dashboard that showed them exactly where their risks lay, with no hidden corners or black boxes. This internal transparency was the first line of defense against the kind of style drift that had doomed his previous firm. Externally, this philosophy translated into a new relationship with investors. The first believers who backed Veritio were given a level of insight into the firm's operations and risk profile that was uncommon at the time. Maunus understood that he could not simply ask for blind trust, he had to earn it by being radically open about his process. This meant clear communication about the firm's strategies, its risk controls, and its performance. The goal was to build a partnership with investors based on mutual understanding, not on the mystique of a star manager. The name Veritio was a promise that there would be no more surprises and no more misrepresentations of the firm's strategy. Ultimately, the philosophy of Veritas was a cultural reset. It was about fostering an environment where difficult truths could be told and heard. It empowered risk managers to challenge portfolio managers and encouraged an open dialogue about potential vulnerabilities. It was a culture that valued skepticism over bravado and prized the preservation of capital over the reckless pursuit of glory. By embedding the concept of truth into the very name and identity of his new firm, Nicholas Maunus was making a public and permanent commitment to a new way of doing business. It was his way of acknowledging that the path to redemption began with a brutal and unwavering commitment to honesty. With a new philosophy in place and seed capital secured, the primary task for Nicholas Maunus was to construct the operational and risk management infrastructure of Veritio. This was not just a matter of hiring traders, it was about building a fortress. The architecture of the firm was designed with one paramount objective: to survive. The lessons from Amaranth's collapse were the blueprints for this new construction. Every system, every process, and every hire was oriented around the principle of robust, multi-layered risk control. Maunus was not building a nimble speedboat designed for speed, he was building a heavily armored battleship designed to withstand the most violent storms the market could throw at it. The cornerstone of this fortress was an independent and empowered risk management department. At many funds, the risk team can be subservient to the profit-generating portfolio managers. At Veritio, the risk department was established as a separate and equal center of power within the firm, reporting directly to Maunus. Its mandate was clear and absolute: to enforce the risk limits assigned to each trading team. Without exception, risk officers were given the authority to order a team to cut its positions if a limit was breached, regardless of the portfolio manager's opinion or track record. This created a crucial system of checks and balances that had been fatally absent in Amaranth's final years. Beyond the individual team limits, Veritio implemented a sophisticated, firm-wide risk aggregation system. This technology provided a holistic view of the fund's total exposure across all strategies, asset classes, and geographies. It allowed the leadership to identify and manage potential concentrations of risk that might not be apparent when looking at each team in isolation. For example, it could flag if too many supposedly different strategies were inadvertently making the same underlying bet on interest rates or a particular currency. This top-down, panoramic view of risk was the early warning system designed to prevent the firm from ever again having a single dominant exposure that could threaten its solvency. This meticulous focus on building a resilient foundation was the most tangible evidence of Maunus's transformation. He poured his energy and resources not into finding the next hot trade, but into perfecting the systems that would protect the firm from the next unexpected crisis. It was a slow, painstaking, and unglamorous process, far from the thrill of the trading floor, but it was the essential work required to build a firm that could last. Veritio was born not as a vehicle for spectacular returns, but as an institution engineered for endurance. The fortress was built, the defenses were in place, and the quiet, methodical journey of rebuilding a legacy could now begin. For the first decade of its existence, Veritio Fund Management operated in a state of self-imposed obscurity. The firm's growth was not explosive. It was methodical, deliberate, and almost painstakingly slow. This was by design. Nicholas Maunus was not trying to recapture the lightning in a bottle that had characterized Amaranth's meteoric rise. Instead, he was focused on executing his new model with discipline and consistency. The primary goal was not to generate headline-grabbing returns, but to build a stable, verifiable track record of positive performance with low volatility. He understood that trust, once shattered, could not be rebuilt overnight. It had to be earned back over years of quiet, reliable execution, one successful quarter at a time, far from the glare of the financial media. The strategy was one of patience. Maunus and his team focused on slowly and carefully adding new portfolio management teams to the platform. Each new team was vetted not just for its potential to generate profit, but for its cultural fit and its commitment to the firm's rigid risk management framework. Veritio became a haven for talented traders who were tired of the boom and bust cycle of other firms and sought a stable environment where they could run their strategies with institutional support and clear, consistent rules. The firm grew organically, adding teams in areas like global macro, equity long-short, and quantitative strategies, gradually increasing its diversification and strengthening the resilience of the overall portfolio. It was the slow, steady work of laying one brick at a time. Throughout the 2010s, a period marked by bull markets and relative calm, Veritio's performance was solid but not spectacular. It did not shoot the lights out, nor did it try to. The fund delivered the kind of steady, risk-adjusted returns that it had promised its first believers. Assets under management grew at a respectable but modest pace, climbing from its initial $185 million to just over $1 billion by the end of the decade. In the high-stakes world of hedge funds, this was considered slow growth. But for Maonis, it was a profound success. He had proven that his new model worked, he had demonstrated that he could manage capital responsibly and navigate the markets without courting disaster, rebuilding his reputation one day at a time. This long, quiet decade was the most crucial period in Veritio's history. It was the time when the firm forged its identity and proved its resilience. It operated without fanfare, building its fortress brick by brick while the rest of the world was largely unaware of its existence. This was the period of rebuilding not just a company, but a legacy. Maonis was demonstrating through action, not words, that he had learned the lessons of his past. He was proving that the man who presided over one of Wall Street's most infamous collapses could also architect one of its most disciplined and durable platforms. The foundation was set, the track record was established, and the stage was prepared for a dramatic and unforeseen acceleration. The year 2020 unleashed a storm upon the global markets. The COVID-19 pandemic triggered a level of volatility and uncertainty not seen since 2008. Stock markets plummeted with breathtaking speed, credit markets froze, entire sectors shut down. For hedge funds, it was the ultimate stress test. Many firms, including industry giants, suffered staggering losses as their models broke down. The chaos was a brutal separator, exposing the fragile and rewarding the resilient. It was in this crucible of fear that Veritio Fund Management would face its most definitive test. As markets melted down, Veritio did not just survive, it thrived. The firm's multi-manager approach proved perfectly suited for the chaotic environment. While directional funds betting on markets were decimated, Veritio's independent teams found opportunities in the dislocation. Strategies designed to profit from volatility, arbitrage opportunities, and relative value trades all performed well. The fortress that Nicholas Maonis had spent a decade building held strong. The risk controls worked exactly as designed, preventing fatal losses while allowing others to capitalize on turmoil. The firm posted positive returns in the first quarter of 2020, when the S&P 500 lost over 20%. It continued generating gains throughout the year, ending with solid performance. This was a remarkable achievement that did not go unnoticed. While other managers explained away huge drawdowns, Veritio was delivering on its core promise, to protect capital and generate returns in any market environment. The pandemic was ultimate validation of the Veritio model. It proved that Amaranth's lessons had been fully learned. The failure of the past became the blueprint for surviving the future. This performance was a major turning point. Institutional investors who had shunned Maonis were forced to take a fresh look. In a world desperate for reliable returns, Veritio's track record stood out like a beacon. The firm had navigated the bull market and proven its mettle in crisis. It was the complete package, making money in good times, protecting it in bad times. The quiet work of 10 years was about to pay off. The industry was about to come knocking on his door. The aftermath of Veritio's stellar performance during the 2020 pandemic was a dramatic and decisive shift in its fortunes. The firm that had operated in relative obscurity for more than a decade was suddenly thrust into the spotlight. Large institutional investors, the very pension funds, endowments, and foundations that had once blacklisted Nicholas Maonis, were now clamoring for an introduction. They saw in Veritio a solution to their biggest problem: how to find sources of return that were not dependent on the stock market. Veritio's success in the midst of chaos was the most powerful marketing tool imaginable. The long, slow process of rebuilding trust was over. The floodgates of institutional capital were about to open. The growth in assets under management was nothing short of explosive. Having taken a full decade to reach the $1 billion mark, Verition's assets under management began to skyrocket. In the years following the pandemic, the firm experienced an unprecedented inflow of capital. By 2021, assets had surged past $3 billion. By 2022, they had crossed $6 billion. The momentum continued to build, and by 2023, Verition was managing nearly $12 billion. In just a few short years, the firm had grown tenfold, transforming from a boutique operation into a major institutional player. This was not the speculative hot money that had chased Amaranth's returns. This was stable, long-term capital from the world's most sophisticated investors. This rapid expansion was a testament to the scalability of the Verition platform. Because the firm was structured as a federation of independent trading teams, it could absorb new capital by allocating it to existing teams or by bringing new teams onto the platform. This allowed the firm to grow without compromising its risk management principles or forcing its managers to take on more risk. The growth was managed with the same discipline and caution that had characterized the firm's early years. Maonis was careful not to let the sudden success lead to the kind of hubris that had destroyed Amaranth. The focus remained squarely on risk control and sustainable performance. This explosion in assets marked the completion of Maonis's comeback. He was no longer the exiled founder of a failed firm. He was now the head of one of the fastest-growing and most sought-after multi-strategy hedge funds in the world. He had not only reclaimed his place in the industry, but had built something larger, stronger, and more resilient than what he had lost. The quiet, patient rebuild had culminated in a resounding success, proving that a reputation, no matter how badly damaged, could be fully restored through years of disciplined execution and an unwavering commitment to a better model. The firm born from the ashes of a spectacular failure was now a titan in its own right. Verition's incredible resurgence did more than just restore the reputation of Nicholas Maonis. It helped to popularize a new blueprint for the modern hedge fund. The firm's success demonstrated the immense power of the multi-manager platform model, where the fund itself acts as a centralized provider of capital, technology, and risk oversight for a diverse collection of trading talent. This model, often called a pod shop, shifted the focus away from the genius of a single-star manager and toward the strength of the overall system. Verition became a case study in how to build a resilient, scalable, and highly profitable investment firm for the 21st century, influencing a new generation of fund managers. The firm that was once built on the cult of a single-star trader had now become the anti-star platform. At Verition, the institution is the star. The firm's brand is built on its process, its infrastructure, and its risk culture, not on the reputation of any individual portfolio manager. This makes the business far more durable. If a trading team underperforms or decides to leave, it can be replaced with another without threatening the stability of the entire enterprise. This plug-and-play approach to talent has made Verition a magnet for traders, who are drawn to the opportunity to run their own strategy with the backing of a major institution, all while being insulated from the business risks of starting their own fund. From an industry pariah, Maonis had transformed himself into the architect of a premier platform. His greatest failure, allowing a single point of failure to destroy his firm, had become the source of his greatest strength. He had turned the painful lessons of Amaranth into a guiding doctrine for building a robust and enduring institution. The story was no longer about the man who lost $6 billion, but about the man who built a $12 billion fortress on the ruins of his past. This narrative of redemption and reinvention is a powerful one on Wall Street, a world that respects resilience above almost all else. Ultimately, the rebuild of Verition provided a new blueprint for success forged in the crucible of failure. It showed that it was possible to come back from a career-ending disaster not by denying the past, but by confronting it, learning from it, and using its lessons to build something fundamentally better. The journey from the quiet, humble launch in 2008 to the industry powerhouse of today is a testament to the power of patience, discipline, and a clear vision. Nicholas Maonis did not just rebuild his career, he rebuilt the very model of what a hedge fund could be, turning his personal story of failure into a blueprint for institutional success. The fundamental difference between Veritio and its ill-fated predecessor, Amaranth, lies in a profound philosophical shift away from the cult of the individual. Amaranth, in its final tragic chapter, became a testament to the dangers of the star trader model. The firm's fate was tied to the convictions and ego of a single person, Brian Hunter, whose success was so dazzling that it blinded the firm to the catastrophic risk it was taking. This concentration of power and reliance on a lone genius created a single point of failure that ultimately proved fatal. Veritio was born from the ashes of this philosophy, built on the deliberate and complete rejection of the very idea that any one person should ever hold such sway over the firm's destiny. The guiding principle is simple: the system must be the star, not the trader. At Veritio, the core philosophy is that sustainable success comes from a robust and diversified system, not from the heroic bets of a single manager. The firm is architected as a platform, a carefully managed ecosystem where dozens of specialized portfolio management teams operate independently, but within a strictly controlled environment. This model intentionally dilutes the influence of any single individual. The traders at Veritio are highly skilled and valued, but they are components of a larger machine, not the machine itself. Their success contributes to the whole, but their failure is designed to be a contained event. A small, manageable loss that the broader firm can easily absorb without threatening its overall stability. This is a fundamental inversion of the Amaranth model. This shift in philosophy changes the entire dynamic of the firm. It moves the center of gravity from the trading desk to the risk management department. At Amaranth, the power resided with the person generating the biggest profits. At Veritio, the ultimate authority rests with the system of controls and the people who enforce them. This ensures that the pursuit of profit is always subordinate to the preservation of capital. The firm actively seeks to avoid the kind of outsized, home-run trades that made Amaranth famous and then infamous. Instead, it aims for a steady accumulation of smaller, uncorrelated profits from a wide variety of sources, creating a return stream that is designed to be less spectacular but vastly more reliable and durable over the long term. This philosophical commitment to the system over the star is the single most important element that makes Veritio different. It is my direct answer to my own history. I experienced firsthand how the intoxicating allure of a star performer can lead to a catastrophic breakdown in judgment and process. By building Veritio around a philosophy that explicitly guards against this, I have created a firm that is not just structurally different, but culturally different. It is a place where process trumps personality, where risk control is more celebrated than reckless courage, and where the collective strength of the system is the ultimate guarantor of its success, ensuring the past will never be repeated. The philosophical shift at Veritio is made tangible through a meticulous and deliberate architecture of control. The key to this structure is a brilliant paradox. It simultaneously decentralizes the sources of risk while centralizing the oversight of that risk. On the one hand, the firm operates with more than 140 distinct portfolio management teams, each running its own specialized strategy. This decentralization is the first line of defense. By spreading capital across so many different teams and strategies, from equity arbitrage to macro trading to credit derivatives, the firm ensures that it is not exposed to the failure of any single idea or market. If one team has a bad month or a bad year, its impact on the overall firm is minimized, becoming a small ripple in a very large ocean. On the other hand, while the trading and risk-taking are decentralized, the monitoring and control are intensely centralized. Every one of those 140-plus teams is subject to the authority of a single, independent risk management department that reports directly to the firm's senior leadership. This central nervous system has a real-time, top-down view of every position held across the entire firm. It is armed with sophisticated technology that aggregates and analyzes risk exposures, looking for unintended concentrations or correlations between supposedly separate strategies. This centralized oversight prevents the kind of siloed thinking that can allow a hidden risk to grow unnoticed until it is too late to control. This architecture of control is enforced through a system of hard, non-negotiable risk limits, often referred to as gross exposure and net exposure caps. Each portfolio team is allocated a specific amount of capital and given strict limits on how much leverage they can use and how much directional risk they can take. These are not guidelines, they are rules etched in stone. If a team breaches its limit, the central risk department has the authority to intervene and force a reduction in the position. There are no exceptions for star performers or managers on a hot streak. This rigid discipline ensures that no single team can ever grow powerful enough to threaten the stability of the entire platform, a direct lesson from the Amaranth playbook. This structure is what truly separates Veritio from its predecessor. Amaranth in theory was a multi-strategy fund, but in practice, its risk became dangerously centralized in one strategy. Veritio's architecture makes that outcome a structural impossibility. The firm is not just managed, it is engineered. I built a system where the architecture itself is the primary defense against the kind of human error and hubris that brought down my first firm. It is a model of control that trusts in process and systems over the fallible judgment of any individual, creating a fortress designed to withstand the pressures that cause other firms to crumble. Beyond the hardwired systems and the formal architecture of control, what truly makes Veritio different is its culture. I understood that a firm's character is shaped not just by its rules, but by the values and behaviors it promotes. The culture I deliberately cultivated at Veritio is the polar opposite of the gunslinging bravado that often permeates the hedge fund world. It is a culture rooted in humility, discipline, and a deep, abiding respect for the power of the market to humble even the most brilliant minds. This ethos flows directly from my own experience. Having suffered a public and catastrophic failure, I have an authentic understanding of the dangers of arrogance and overconfidence. This culture of humility manifests in a constant questioning of assumptions. At Veritio, traders are encouraged to focus not just on how a trade can make money, but on how it can lose money. The firm fosters an environment where it is safe to admit mistakes, to raise concerns, and to challenge the consensus view. This stands in stark contrast to firms where traders feel pressured to project unwavering confidence at all times. By institutionalizing a degree of skepticism and intellectual honesty, Veritio creates a more resilient organization, one that is less likely to be blindsided by unexpected events because it is constantly stress-testing its own ideas and looking for potential points of failure before they materialize. Discipline is the other pillar of Veritio's culture. It is one thing to have risk limits on paper, it is another thing to have a firm-wide culture that genuinely respects and adheres to them. At Veritio, discipline is not seen as a constraint on performance, but as the very foundation of it. The firm attracts and retains traders who are comfortable working within a structured, rules-based environment. They understand that long-term success in the investment business is less about moments of genius and more about the consistent application of a sound process over time. This shared commitment to a disciplined approach creates a cohesive and stable environment, free from the drama and volatility of personality-driven firms. Ultimately, this human element is perhaps the most difficult component to replicate and the most crucial to Veritio's success. I did not just build a better risk model, I built a better culture. I harnessed the painful lessons of my past to foster an environment where the avoidance of catastrophic error is the highest virtue. It is a culture that prioritizes survival over spectacle and consistency over short-term glory. This quiet, disciplined, and humble approach is the soft-wired human complement to the firm's hardwired architecture of control. And it is what makes Veritio a truly different and enduring institution in the world of finance. If Amaranth was a finely tuned racing car, built for maximum speed and acceleration, then Veritio is a main battle tank, engineered for endurance, armor, and all-weather survivability. This fundamental difference in engineering philosophy is the ultimate expression of what makes Veritio different. The firm is not optimized to produce the highest possible returns in a bull market. Instead, it is optimized to survive and even thrive in any market environment, especially the most chaotic and unpredictable ones. This focus on resilience, rather than raw performance, is a direct consequence of the lessons learned from Amaranth's high-speed crash. Nicholas Maunis is no longer interested in winning a single race, he is interested in finishing every marathon. This engineering for endurance is evident in every aspect of the firm's strategy. The emphasis on market-neutral and relative value strategies means that Veritio's success is not contingent on the overall direction of the stock or bond markets. Many of its teams are structured to be profitable whether the market goes up, down, or sideways. This insulates the firm from the violent swings of macro events and provides a source of return that is genuinely diversified from traditional investments. This was proven during the 2020 pandemic crash, when the firm's resilience factor allowed it to post gains while many others were suffering devastating losses, a real-world validation of its all-terrain design. The firm's approach to growth also reflects this philosophy of endurance. The explosive increase in assets after 2020 was managed with extreme care. Instead of simply piling more capital onto existing traders and increasing their risk, Veritio carefully onboarded new teams and diversified into new strategies. This measured approach ensures that the firm's growth does not compromise its risk management integrity. The goal is to build a platform that can last for decades, not one that burns brightly for a few years before flaming out. This long-term perspective, prioritizing the durability of the institution over short-term gains, is a hallmark of its unique, survival-focused engineering. In the final analysis, the resilience factor is what truly sets Veritio apart. In an industry often obsessed with quarterly performance and league tables, Veritio plays a different game. It is a game of longevity, capital preservation, and institutional durability. Maonis took the blueprint of his greatest failure and used it to engineer a firm that was its polar opposite in every meaningful way. He traded the pursuit of speed for the certainty of armor, and in doing so, built a vehicle not for a single glorious race, but for the long, arduous, and unpredictable journey through the markets. This commitment to being the last one standing is the ultimate legacy of his comeback. The story of Nicholas Maonis is not one story but two. It is a narrative with a dual legacy, embodied by two vastly different firms, Amaranth Advisors and Veritio Fund Management. Each name carries its own powerful weight and leaves behind its own distinct lesson for the financial industry. The legacy of Amaranth is a stark and enduring cautionary tale. It serves as a permanent reminder of the seductive dangers of hubris, the catastrophic potential of concentrated risk, and the fragility of a reputation built on the myth of an infallible star trader. Amaranth's name is etched into the annals of financial history as a byword for spectacular failure, a ghost that haunts boardrooms and risk committees to this day, reminding everyone of how quickly a titan can fall. The lessons from Amaranth's collapse are now fundamental tenets of modern risk management. The story is taught in business schools and drilled into new generations of analysts and portfolio managers. It illustrates the critical importance of enforcing risk limits, the folly of allowing a single strategy to dominate, and the fatal consequences of style drift. The firm's implosion was a public and painful seminar on the brutal mathematics of leverage and the unforgiving nature of the market when confronted with overconfidence. Its legacy is one of loss, not just of capital but of trust and credibility. And it serves as a powerful deterrent against the kind of reckless behavior that led to its demise. In stark contrast, the legacy of Veritio Fund Management is one of quiet, methodical success, built directly upon the wreckage of that failure. Veritio stands as a testament to the power of resilience, discipline, and institutional design. Its legacy is not a cautionary tale but an inspirational blueprint. It demonstrates that a culture of rigorous risk control and a system of true diversification are not constraints on success, but the very foundations of it. Veritio's story proves that it is possible to build a world-class investment firm not by chasing spectacular returns, but by relentlessly focusing on the preservation of capital and the delivery of consistent, reliable performance over the long term. Ultimately, the dual legacy of these two funds provides a complete and powerful narrative arc. One cannot be fully understood without the other. Amaranth represents the problem, the catastrophic failure born of a flawed philosophy. Veritio represents the solution, the resilient institution engineered with the hard-won wisdom gained from that failure. Together, they tell a story that is more profound than a simple tale of collapse or comeback. They offer a comprehensive lesson on the nature of risk, the importance of structure, and the possibility of redemption. Nicholas Maonis did not just create two firms, he created a powerful, real-world case study that will inform and guide the financial industry for decades to come. At the center of this dual legacy lies the Maonis paradox, the idea that his greatest failure was the necessary precondition for his greatest success. Without the public humiliation and catastrophic loss of Amaranth, the disciplined, risk-averse fortress of Veritio could never have been conceived, let alone built. It was the searing pain of that experience that became his ultimate teacher, providing him with a level of insight into risk that cannot be learned from a textbook or a simulation. He had stared into the abyss of total firm failure, a crucible that forged a new and unbreakable conviction around capital preservation and institutional resilience. This paradoxical journey is the core of his personal legacy. This paradox challenges the conventional view of success and failure in finance. The industry typically celebrates an unblemished track record, viewing any major loss as a permanent stain on a manager's reputation. The story of Nicholas Maunis suggests a different perspective. It argues that a manager who has failed spectacularly and has deeply internalized the lessons may ultimately be a safer and more prudent steward of capital than one who has never faced true adversity. His experience gave him a unique form of scar tissue, a visceral understanding of worst-case scenarios that makes him less likely to repeat the mistakes of the past and more obsessed with building defenses against the unknown. The Maunis paradox also speaks to the human capacity for learning and adaptation. His comeback was not simply starting a new firm with the same old ideas. It was a complete reinvention of his own philosophy as a leader and an investor. He had to unlearn the habits that led to Amaranth's downfall and adopt a new mindset rooted in humility and systematic control. This transformation from the enabler of a star trader to the architect of a star system is a powerful testament to his ability to learn, evolve, and apply the harshest lessons in a constructive way. His story becomes one of post-traumatic growth, where the trauma of failure becomes the catalyst for building something stronger and more enduring. This legacy redefines what it means to be a successful fund manager. It suggests that the path to wisdom is not always a straight, upward line. Sometimes it requires a catastrophic fall. The Maunis paradox is a powerful lesson for any leader in any field. Failure is not the opposite of success. It is an integral part of the journey toward it. By embracing his past and using it as the blueprint for his future, Nicholas Maunis did more than just rebuild his career. He created a new and compelling archetype for a leader who is made stronger, wiser, and ultimately more trustworthy by the very scars of their past defeats. Beyond the personal story of Nicholas Maunis, the rise of Veritio has left an indelible mark on the structure of the hedge fund industry itself. The firm's success has helped to popularize and refine the blueprint for the modern multi-strategy or multi-strat platform. While the model existed before Veritio, its disciplined execution and spectacular growth, especially after 2020, provided a powerful proof of concept that many others have sought to emulate. Veritio became a leading example of how to build a scalable, resilient, and highly profitable investment firm by focusing on the system rather than on a single manager, a lesson that has resonated deeply across Wall Street. The Veritio blueprint emphasizes a few key components that have become industry best practices. First is the radical decentralization of talent, spreading capital across a vast number of independent teams to achieve true diversification. Second is the intense centralization of risk management, creating a powerful, independent oversight function that acts as the firm's central nervous system. Third is the focus on building a robust operational and technological platform that provides traders with everything they need to succeed, allowing them to focus purely on their investment strategy. This combination has proven to be a winning formula for attracting both top-tier trading talent and sticky institutional capital. This model has fundamentally changed the career path for many talented traders. In the past, a successful portfolio manager's ultimate goal was often to leave a larger firm and launch their own standalone hedge fund. The Veritio blueprint offers a compelling alternative. By joining a platform like Veritio, traders can gain access to significant capital, world-class infrastructure, and a stable operating environment without the immense headaches and business risks of starting their own company. This has led to a major talent migration towards large multi-strat firms, which have become the dominant players in the hedge fund landscape, managing hundreds of billions of dollars collectively. Veritio's legacy, therefore, is not just its own assets under management, but its influence on the very structure of its industry. It stands as a premier example of a firm that has perfected the platform model, turning risk management and institutional design into a competitive advantage. The firm's journey from a small post-disaster startup to a multi-billion-dollar powerhouse provided a clear and compelling roadmap for others to follow. In this way, Nicholas Maunis did not just build a successful company, he helped forge the dominant business model for the modern hedge fund, leaving a lasting structural legacy on the world of finance. The story of Amaranth and Veritio offers a profound and evolving lesson for the investors who allocate capital to hedge funds. The collapse of Amaranth was a brutal education in the dangers of misplaced trust. It taught investors that a firm's marketing materials and its stated strategy can sometimes diverge dramatically from its actual risk profile. It underscored the need for deeper due diligence, for asking tougher questions about risk concentration, and for looking beyond a fund's recent performance to understand the underlying processes and controls. The lesson from Amaranth was one of skepticism: trust, but verify, and be wary of any manager who seems to have found a magic formula for success. The rise of Veritio, however, offers a new and more nuanced definition of what a trustworthy manager looks like. It suggests that trust should not be placed in an individual's genius or their unblemished track record alone. Instead, true, durable trust should be placed in the quality of a firm's system, the robustness of its processes, and the strength of its culture. Veritio's appeal to sophisticated institutions is not based on a promise of spectacular returns, but on the promise of a well-engineered, resilient system designed for survival. Investors learn to trust the architecture of control that Amaranth built, recognizing it as a more reliable foundation than the charisma of any star trader. This shift represents a maturation of the institutional investor community. The takeaway is that the most important questions to ask a manager are not just about their investment ideas, but about their risk framework. How do you manage your exposures? What happens when a trade goes wrong? Who has the power to say no? How is your firm structured to prevent a single mistake from becoming a catastrophe? The Veritio story has taught investors to value the role of the chief risk officer as much as the chief investment officer, and to see a firm's investment in risk infrastructure as a key indicator of its quality and long-term viability. Ultimately, the lesson for investors is that the safest hands are not necessarily those that have never made a mistake, but those that have learned from their mistakes in the most profound way. The journey of Nicholas Amaranth provides a compelling, if paradoxical, reason to trust him again. He built a firm whose entire existence is a monument to the lessons he learned from his greatest failure. For investors, the takeaway is a new understanding that the most trustworthy institutions are not those that pretend to be infallible, but those that are built with a deep and humble awareness of their own fallibility and have engineered a system to protect against it. In the end, the untold story of Amaranth and Veritio is a powerful human drama about redemption and reinvention. It transcends the cold, hard numbers of finance and speaks to a universal theme: the ability to overcome catastrophic failure and build something better from the ruins. Nicholas Amaranth's journey from industry pariah to respected leader of a multi-billion-dollar firm is one of the most improbable comeback stories in Wall Street history. It serves as testament to the power of perseverance, humility, and willingness to confront past mistakes head-on, rather than run from them. The story is not about forgetting the past, but harnessing it. Amaranth did not escape the shadow of Amaranth. He stepped into it and used its lessons as his guide. This is the essence of true reinvention. It's not about creating a new identity to hide an old one, but integrating past experiences to forge a stronger, wiser future self. He transformed his greatest liability, his association with massive failure, into his greatest asset: unique expertise in risk management. This act of transformation is the core of his legacy and offers an inspiring lesson for anyone facing insurmountable setback. The final chapter is not about absence of failure, but about the response to it. Failure is not a final destination. It can be a powerful catalyst for change, a crucible that burns away arrogance and leaves behind wisdom and resilience. The contrast between the two firms, Amaranth and Veritio, is testament to this truth. One built on pursuit of glory and speed, the other on discipline and endurance. The success of the second, built by the same man who led the first, is a powerful statement about human capacity for growth. In the unforgiving world of finance, where reputations are made and shattered instantly, the story of Nicholas Amaranth stands apart. It closes not on tragedy, but on profound, hard-won triumph. He didn't just rebuild a firm, he rebuilt a legacy. By turning his most public failure into a blueprint for a resilient future, he wrote a final chapter, not about money that was lost, but about invaluable wisdom gained. It's a powerful reminder that failure is never the end, unless you allow it to be.